Thanks for tuning into Talking Point. Now, I'm your host Niraj Shah, and the case for a chat today is the Indian consumer slowing down, or has she already been buying less, especially in the rural end of the market? That is a key question that comes out of the commentary that we've heard from some companies across the landscape. The question again is that if it is a slower consumption growth, can that slower consumption growth hit consumption and allied companies in Q4 as well? That's the other key question that one needs to figure out. And thirdly, is there a need for a defensive portfolio at the current times, or not necessarily so? Because you now heard for at least 3 months, if not longer, about how market mein correction abhi aane wala hai. So I think let's take all of those questions to our guest today. Mr. Milind Karmarkar of Dalal and Brocha PMS joins us right now on Talking Point. Milind, so good having you.
Thank you.
Thanks for joining in today.
Thank you.
The pleasure is entirely ours. I want to start off with the big one. Do you worry about this, that there is a correction imminent? Let me sit on a bit of cash. Niche ke bhav pe lene ko milega. Do you think about it?
So, you know me, Niraj, and basically our focus is long term.
Yes.
And we don't, frankly, we don't bother about short term corrections. So, whether Q4 is going to be slow and because of that I should move to cash. No, that is not how we look at companies. We look at companies with a view that in 5 years' time, is it possible that the company will more than double? I mean, its turnover and its profits. So, if the answer to that is yes, we don't mind small short-term bips, and in fact, we may add. So, we always have 4 to 5% cash, and whenever these type of opportunities come in, we would like to add to the portfolio. So, selling because there is a short-term issue is not the strategy which we follow.
Is there a short-term issue?
So yes, because some of the FMCG companies have shown kind of slower growth. There are people who are saying that rural is slowing down, but if you believe that India is at a cusp of the next growth phase, where if you see most of the neighboring countries, whether it's Singapore, Thailand, Malaysia, China, or even for that matter Japan in 60s and so on and so forth. Once a country crosses $2,000 per capita income, the move from $2,000 to $6,200 or $6,000 is very rapid. And if that is what we believe in, and so if the forget about tripling, but if the per capita GDP is going to even double in next 5 years, then we could. So what we are effectively, what will happen is that what the GDP is today, we will be consuming in about 5 years' time. So there is a massive opportunity. So that is the reason we are not so worried about.
Sorry, can you explain that point again?
So consumption normally is around 50% of the GDP. So if GDP doubles, whatever is today's GDP, we will be consuming after 5 years. So then the opportunity seems to be very large. But if I look at the US, there was a time from probably late 60s to early 70s when we had most of the FMCG companies who were the top performing companies in the US. But in 20 years, it was predominantly the retailing companies which were the top performing companies. Because the baton of pricing power moves from FMCG companies to retailing. And I do see that happening in India as well. So that is the reason probably FMCG companies may not have that kind of a glamour which was there earlier. But at the same time, consumption will do well. That is not an issue.
Got it. Actually, and I'll come to FMCG as well, but just rounding off this whole thing around the macro, one of the most talked about corporate comments was the quote from Baba Kalyani about how they see imminent slowdown both in domestic and export markets, and that might hit. Now, post that, we've spoken to a number of corporates asking them about their views on whether they see a slowdown around their business. Anish Shah yesterday ruled it out for their company. Cummins MD, both for global and local, said that for their businesses, it doesn't look very, very pronounced. G Shipping today said that based on the shipping of commodities that they are doing, consumption of commodities is still strong. I'm just trying to understand, when you look at the landscape, while you look at consumption very closely, but if you look at the overall macro, do you fear an imminent slowdown, or do you reckon it could be transitory in nature?
So our portfolio is predominantly focused on India. So that is one thing. But yes, when it comes to the global situation, there could be a slowdown. But that
could it impact India?
Sorry?
Could it impact India?
To some extent. So let me go back to 2003, when we had, prior to that, we had the 9/11 and lot of issues. And I remember Reserve Bank's comments on 1st of April for the next financial year. And they said that though India is one of the fastest growing economies, there is a distinct slowdown which we can see globally. It is possible that some of the large economies in the West may go into a recession. And there is a Iraq war. So despite of all this, we do expect India to do well, but we will be cautiously optimistic. So that is what they said. Come to 2024, I think the commentary is going to be exactly the same.
Okay, fine. Okay, great. Now let's talk about. Let's start off with consumption, and we'll talk about it in both before and after the break.
Sure.
We'll talk about something else as well.
Yeah.
And I'll come to your most decorated investment in some time later, because it's not just about one investment, right? You're doing so well on the portfolio.
No.
Is the portfolio bent towards taking advantage of the K-shaped consumption piece that we're seeing in India and the upper crust thereof, or not necessarily so?
So let me just clarify here that, again, first of all, I need to clarify that whatever stock specific we discuss, there is a possibility that we may own the stock. In fact, it's more likely that we may own the stock, and I may own the stock myself as well.
Got it.
So this is not a recommendation, and it is only for discussion purpose.
Right.
Okay. So coming to the way we look at consumption, we look at all the sectors which benefit out of rising per capita income. So whether it's finance, whether it's also banking and finance, whether it's insurance, which has been lagging for last 4 years. But despite that, so whether it's finance, whether it's insurance, whether it's healthcare, including hospitals and pharmaceuticals, and of course retail and FMCG, we do believe that, and travel. So we do believe that all these sectors will benefit significantly. So our sort of map of consumption is much larger rather than only focusing on a certain aspect. So we continue to believe that this sector as a whole, there could be some which may not do so well and some which will do very well, but this sector as a whole will deliver very good returns, or in fact I can say that market beating returns in the next 5 years.
What within this? Some will do well, some will not. Let's talk about the ones which you believe will do well.
Okay, so what will do well? I think finance, banking and finance should do well, because whenever it's a consumption driven growth, there is always need for loan. And because of that, we do expect that retail centric banks are likely to do very well. In fact, I wouldn't be surprised if they deliver a 18% year or 18 to 20% year on year growth for next 5 years. Albeit currently, I mean, if you see, some of them have not done so well, but at the same time, I do believe that over a longer period, because banking and finance, if economy does well, banking and finance has to do well, period. There's no two ways about it. So that's why banking and finance is one. Hospitals, I think I have talked about it earlier also, that when I met Dr. Devi Shetty long back and I asked him, what will drive growth of hospitals? They had just listed that time. So he had told me that it's predominantly insurance penetration and rising per capita income. Same thing Dr. Reddy of Dr. Reddy's lab told me way back in 95 when they were focusing more on exports rather than domestic, because he said that in India, people don't have money to spend on medicines or hospitals, and that is the reason why our focus is exports. But as your per capita income goes up, there is a very distinct possibility that Indian pharma will do very well. So I missed out on pharma some time back. So pharma also constitutes a consumption story for us.
Got it. Okay. And so there is pharmaceuticals, there is BFSI and lenders, private banks which might do well. Private banks, not necessarily SOEs. State-owned banks.
We have a couple of PSUs in our portfolio, and again, there is reason for that. Like we have Jammu and Kashmir Bank in our portfolio. So in August, when I had gone to Kashmir, I saw that Valley had come back almost to normal, and in most of the places there was J&K Bank, presence, while other banks were not there. It's not that over a period other banks will not come in. The management had changed completely. And J&K Bank is likely to be the biggest beneficiary of peace returning to the valley, where people will have more spending power. So that's why J&K Bank and SBI, because I think that even technologically they are doing something very nice and they will benefit. So these are the two PSU banks which we have in the portfolio. The others are predominantly retail centric banks.
Got it. Just one question on lenders, by the way, before we move on.
Yeah.
Do you reckon that this valuation catch up that PSUs, in the last 5 years, SOE banks have done better than the private banks as an index?
Yes.
Do you think this valuation catch up still has room to go? So my question rather is that would a J&K or an SBI or whatever else, will it benefit both from earnings growth as well as further valuation re-rating as well, or is that story over?
So I doubt whether they will benefit from their income growth.
Income growth, okay.
Yeah, they may not, because if you go to a PSU bank, you realize that the attitude still needs to change. So that is the issue.
But there has been a valuation re-rating. You don't think there is further re-rating possible?
No, I don't think so.
Okay. Since you've invoked healthcare, before the break, before we take a break, let's just wrap up healthcare. Now, are you therefore you mentioned the thesis around maybe pharma, maybe hospitals, etc. Are you present across that chain, or are you present within specific parts of the chain? Today is a pharma day, by the way. All pharma stocks are rip and roaring.
So we are present in pharma, India-focused pharma companies. Though I must say that we are also focused, we also have a company which is focusing on CRAMS in our portfolio. Hospitals we do have, but it's India-focused pharma companies that we would like to bet on more than pure export-driven companies. We also have a sort of a pharma distribution company in our portfolio, but that is as a purely as a concept stock.
Okay, interesting. But so therefore,
it's a kind of a startup. It's listed, but it's kind of a startup.
Okay, interesting. Okay, but so also hospitals, not necessarily
we
diagnostics.
Have a hospital. Yes, hospital. We are looking at a couple of more hospitals as well.
And diagnostic companies, no.
Diagnostics we don't.
You have avoided. Okay, great. Sorry, just one last question.
Yeah.
I mean, so hospitals, is there a question about them becoming branded players and therefore more pricing power, or is it purely a question of earnings coming through better over a period of time as spending power moves up?
So they are into an expansion mode. So they are something similar to retail. So they will have number of stores added and same store sales growth. So it will be a combination of two.
So what is the trend in the hospital space then? Milind Karmarkar, tell us that.
It's purely like a
retail. Yeah, got it. Pure consumption. I understand you look at consumption across a variety of buckets,
True.
but now I'm drilling it down to pure consumption.
Yeah.
In pure consumption, is there merit in, because you've mentioned this thing about rising per capita.
Yes.
Is there merit in betting heavily on things which are focused on premiumization?
So I was reading a book which talked about conspicuous consumption and inconspicuous consumption.
Okay.
So they defined conspicuous consumption as that consumption, like when people's per capita income increases, for them going to a large format store like a Zudio or Reliance Trends or others, that itself is a big thing. And that is the reason if your masses or a large population is basically coming out of this $2,500, those will be the companies which will grow significantly. In terms of conspicuous consumption or inconspicuous consumption, which is predominantly at the high end, the consumption changes from being showing off your consumption to more towards like hiring nannies or that type of a consumption. So because of that, though people are saying that high-end consumption will do well, I think it's still the base level consumption which is likely to do very well. But within particular consumption, this was more about retail, but within particular consumption, I think take for example the larger companies like Hindustan Lever or any of them, they are fully penetrated. So I remember, so where there was a premium, I remember long back, say when we first started recommending consumption, we used to say that as a kid, my mother used to use 500 ek bar sabun, which was used to clean our clothes, and to soak the clothes, it was shavings of 500 ek bar sabun. There was nothing else available. Then there was surf and other things. Now, if you go to a small village also, you will have surf, you will have shampoo sachets. So, it's fully penetrated. So, there is unlikely to be a volume growth there. Whether there will be a upscaling, I think that will happen only when the per capita GDP goes beyond $5,000. So, as of now, these type of companies which are into personal consumption or not exactly FMCG, personal care products, let me put it that way. There the growth may not be significant, but foods is something which I see a big growth which can come in.
Okay. So, if I look at Q3, I mean, staples largely, sustained to similar demand trends as was in Q2.
Yeah.
Very few companies, except for maybe a Dabur or a Pidilite,
Yes.
came out and gave out some commentary around this thing as well. You look at recency, I suffer from recency bias. I'm asking you, are these pockets of isolation growth, maybe building materials, maybe specialized pharma or consumption products like Dabur does or some others does, and otherwise does it look like a low volume growth kind of a piece on the FMCG side?
No, I think growth will improve.
It will
growth will improve, but it may not be immediately. It will take time, and if your GDP is growing at say 6.5% and you have a 5% inflation, I think at best they will grow at about 12%, not more than that, 12 to 13%.
Okay.
So that is the issue which I have with these companies. But foods is something where direct benefit comes in as your per capita income goes up. So foods and foods and clothes or foods and apparels, that is where maximum growth will come in rather than personal care.
So I understand apparel, there are 2 or 3 ways to play this as well. There could be, I'm just using terms as an example, but there could be an Arvind Fashion or Aditya Birla Fashion Retail, or a Trend, etc., or maybe a Page, whoever likes, whatever, etc. What about foods? How do you play that within this Indian ecosystem?
So you will have to look at larger companies like maybe a Nestle, maybe a Tata Consumer, or these type of, though I don't have them in my portfolio, but these are the companies which can deliver good, or there may be many others. So we have to look at
how are you playing foods? Forget the name. You may not need to give the name, but give us an idea of how are you playing the food space, if it's indeed a good bet.
So we are playing food through one of the food companies. We are looking at a food company as well. So we will continue to do
a food company meaning an FMCG company?
Yes, but when you say fast moving consumer goods, I'm talking about a company which focuses on food and not on personal care. So
got it.
Yeah.
Got it. Okay. The other aspect of consumption in 2 pockets, one of them was QSRs. Everybody believed that QSRs have growth for the foreseeable future. Somehow this quarter, the previous one was a rude roadblock, if you will, despite ICC World Cup, so on and so forth. What's happening here?
So my view is that our focus is predominantly on food tech company. And because they encompass what is represented by QSR, they are indifferent to what they service.
Got it.
So that is why I think food tech companies and have started coming in profit, similar to Policy Bazaar and these type of companies which have started coming in profit. So cash profits I'm talking about. So these type of companies probably are a good sort of a representative of external food consumption.
I have a question, Milind. There was a CLSA note yesterday which said that, I'm using this as an example, that Zomato, they believe, could clock in profits.
Yes.
So because they are looking at profits now, they are changing the valuation methodology to a PE multiple. And therefore, obviously, the target prices could vary materially. If indeed PE becomes the metric, the PE could be high and the earnings could be disproportionate. How would you value food tech? A Zomato or a Swiggy,
so we hold Zomato in our portfolio.
Which is fine. How do you value this company, a company like this?
No, I would value it at earnings after considering growth. It's as simple as that.
Simplify it for us. I'm just trying to understand the valuation methodology.
So I'll tell you. So if a particular stock is quoting at 100 rupees, and let's say their earning is only 1 rupee. So that means you are looking at it 100 times. But if you think that it will double every 2.5 years, the earnings will double every 2.5 years. So rough growth of about 45% or 40%. Then it is very clear that in about 5 years' time, your PE will contract. Either the PE will contract because the earnings will increase. The second is that if they continue to grow at this level, and that point in time, if you consider that this growth is likely to continue, the P will not contract.
Got it.
So that, in fact, that is how we first looked at Trent also. So that is how we are looking at these companies, which is, we always say, value after considering growth.
Okay. I wanted to ask about jewelry, but I'll skip that because I have to ask you about retail and Trent in particular. Now, not as a recommendation, but
Yes.
you've been spot on, Milind, on Trent like no one else that I know. My question is, how do you look at a business like that now that it has rallied so much? There is a bit of growth behind it already, the base is higher, and the valuation leaves hardly any room for execution risk.
Okay. So let me put it this way, that when people say that they have grown so much, or rather when my analyst comes to me and says that, sir, ye bada base hai isliye grow nahi hua, I said that is not an answer.
Okay.
For simple reason that when you are talking of doubling your per capita income, there is no chance that you can take this as a respite for saying that they didn't grow because there was a large base. Of course they have a large base, and because if you look globally, a country having say $30,000 per capita income, in that country this will be nothing. $1 billion turnover is nothing. So that is how one should look at. So if you think that a Trent or any other company is likely to grow at 40%, so you have to look at, is there any scope? So like I remember long back when I used to meet Mr. Tata, I used to ask him, that time they had 2 stores, as to how large they will become. And he used to say that, Milind, I can visualize 90 stores across India in a span of 15 years. And I used to say, wow, that's a 45 times growth. Today they are adding 150 stores everywhere. So in between, when I had met them, I had asked them, it was an analyst meet, so I had asked them, that is, you know, what is your strategy? So they said now increasing density is the strategy. Because earlier if we thought that Bombay, city like Bombay can have only 2 stores, now it can come, we realize that it can comfortably have 10 stores, so that's a 5 times. So this is just an example. I don't know how many stores they have in Bombay. But so that is the kind of opportunity which is there. As your per capita income growth, your consumption grows disproportionately.
Fantastic. Milind, so good having you. Thanks for taking the time out and speaking
Most
to us.
welcome. Most welcome, Niraj.
And viewers, thanks for tuning into this edition of The Talking Point.